Exhale Sunday, the Pod Hangout Lounge for African Youths.
So in Africa, we unfortunately we always take time before we adopt to the changing trends in the world, be it in the world of fashion, be it in the world of technology. We're quite stuck by the usuals. By usuals I mean real estate, property. The difference between a commercial bank and an investment bank. With the investment bank, it helps investors, institutions, fund managers to put their money into good use in the capital markets. Hi guys, this is Ian Collins, an investment banker based in Nairobi, Kenya. So today we look at the state of affairs when it comes to investment banking in Africa, and in particular in Kenya. We'll use definitely the data from Kenya just to give insight to where banking, and in particular investment banking, is in Africa. So let's dive into it. So in Africa, we unfortunately we always take time before we adopt to the changing trends in the world, be it in the world of fashion, be it in the world of technology. And it's not a bad thing. It doesn't mean the fact that we are doing it late that's not effective. But then when it comes to investment banking and fintech in general, we are usually quite slow to adapt. This is with the exception of M-Pesa has history with habit. We really were trendsetter in the world. In fact, M-Pesa is studied in campuses in the better part of developed countries. It's a concept that that's with an exception, and it's an exception because investment M-Pesa by extension is not an investment bank. It's still operating under the telecoms. It's a telecoms product, but then it has all the makings of a bank. In fact, right now or normally is always flack that Safaricom catches because they are operating as they're not being regulated. The conversation is they should be regulated by the Central Bank of Kenya, but they're not. So there's a back and forth, because ideally Safcom is a telecoms, and then it's doing the dealings of a bank. But anyway, that aside, that's an exemption. It's not the rule of thumb. When it comes to investment banking and how we exploit those investment options in Africa, and in particular in Kenya, we're quite stuck by the usuals. By usuals I mean real estate, property, probably or the most common one in entrepreneurship, or savings through circles and what we call chamas. Like if it's not that, then we wouldn't consider it as an investment scheme in Kenya, unfortunately. So because the idea is when you get money, it's actually the 1, 2, 3, 4, 5 of success. 1 being one partner, wife or husband. 2 being 2 kids. 3 means a 3-bedroom house. 4 4-wheel drive, and 5 a 5-acre piece of land. So when you have money and you want to invest it, our go-to options is always going buying land, which given it appreciates due time, But then even with the recent floods, it has really brought things into perspective. Probably land is not the best thing to, and even during time of COVID, when money was scarce and you needed a good flow, because probably there was that unfortunate event, you got a layover, or flows weren't coming because guys weren't getting out of the houses. So money was quite scarce, and you needed your investments to be as liquid, that act of liquidating it. So you see, with land, it becomes a bit difficult when you want to liquidate it, because there's that whole process of now marketing it, and then even that negotiation up until when you exchange. In fact, there's companies that are solely meant to just do that thing for you on your behalf, and you give them their cut. So it goes out to show how hard this liquidating part is, and then as an investment scheme or an investment option, the first or the uttermost important thing should be liquidation, getting your funds as and when you need them. So you see, as Africa, we've been slow when it comes to investment banking, exploiting it, owning it. Because you see, the thing with business, it's only the demand of it that provides the supply. If Kenyans or if Africans are demanding for these investment options, then investment banks will crop up. As of 2022, May, the list of investment banks were barely 20 that are like regulated by the CMA, and that's quite sad, considering we are a population of 50 plus million. So give or take, let's say half of the population are working adults who have a sizable source of income, and still that number is still low for investment banks. It can be less than 20. It should be, let's say, per county, 20 investment banks per county. That would now make sense, but that's not the case, because we're slow to adapting into that trend. Because the only reason I'm giving that flack to Africans and to Kenyans is because when it came to options like entertainment, like right now I'm speaking to you through a podcast, or let's say the typical, now we don't go to movies anymore because of what Netflix has made available to us. When it comes to ordering food, when it comes to even moving from point A to point B, we have adopted in good enough time to Uber, not just as customers but also as business ventures. So why does that conversation have to stop even with the investment options? Until we get to that point that we are embracing investment banking as a whole. I'm not now talking about commercial banking, because there we're good. There's a difference. Actually, the difference between a commercial bank and an investment bank. With the investment bank, it helps investors, institutions, fund managers to put their money into good use in the capital markets. Here, let's say in the capital markets, you're looking to buy shares, you're looking to buy bonds. Let's say you are a company and you want a merger or an acquisition. You come to an investment bank. They can help you list. It's called an initial public offer. So that's what an investment bank does. So you can buy equities. This is now shares of listed companies in the Nairobi Security Exchange. You can buy government bonds, from IFBs to FXDs to Euro bonds to even corporate bonds, treasury bills. You come to an investment bank. Let's say there's also a wing of asset management that's present in an investment bank. So where this is open-ended investment schemes, probably denominated in cash, i.e. probably the equity growth fund, the income fund, or the balance fund. These are just but examples. So you come to an investment bank. Like I said earlier on, let's say you're a company or you need advice on a merger or acquisition, that you come to an investment bank. Where you need structuring of a balance sheet, same thing, you come to an investment bank. When you need to raise capital, probably through capital or debt, still come to us, an investment bank. So that's what an investment bank is, unlike a commercial bank. But technically most banks have a treasury wing in them. An investment bank, when it's still domiciled in that bank, probably the difference is they're not offering it as a service to guys out here, but then they're still doing it, especially the treasury wing, because in fact the treasury generates more than half of the bank's turnover. That's where the real money is made. Like now myself, I work as a dealer in a treasury wing of an investment bank. But see, also I'm an investment bank that also offers it to the public, not just now for the dealings with the bank, as is the case with most commercial banks. So now a commercial bank solely takes in deposits, give out loans. You can make accounts or an account there. They safe keep your money. You can also do a fixed or called deposit. But then it's in the business of taking in deposits and giving out loans. So when it comes to commercial banking, that we're good. Now it's in the investment banking that now the issue lies in. So anybody can, also there's that, there's need to demystify the myth of you need serious money to now visit an investment bank or, get in touch with an investment banker. Not at all, because as low as even 1,000, you can do something with it. You can grow your money. And even now, let's say you make that number one step and join and look for an investment bank. Whatever service they're offering, whatever investment option they're giving, be it the shares, be it the bonds, what you need to look out for as a good investment scheme or as a good investment product will always be this. Like the one I started off earlier during the opening monologue of this, my presentation. It needs to be very liquid. As and when you need the money, you can liquidate those assets. So whatever I've called bonds, shares, they're called asset classes. They are CFDs, the ETFs, depending on what investment bank has as its products. But then the go-to, which you'll always find in most investment banks, is the investing of shares and equities. So there are other now sophisticated products like derivatives, options, where now all these are asset classes or CFDs. Because the idea with investing, the more the risk, the more the return. But also taking that to consideration, you'll be profiled by your investment banker or your advisor or your financial advisor. They'll profile you, they'll assess you, they know what type of investor are you, what is your risk appetite, are you risk averse, are you risk seeking, depending on which, then they'll offer a portfolio with your assets, because what now you'll have is a portfolio of your assets. Then now it's tailor-made for your personality, and also your income, your attitude to risk, how much you can cope in terms of when you lose, some type of money. Your age also plays a part, because the older you are, the more risk averse you get. So if you are more risk averse, then your portfolio will predominantly hold more fixed income products, because with fixed income, that's the bonds, it's always safe or safer, because it's a particular percentage that now we call a coupon, that you're getting into this bond knowing you're getting X amount of percent. Unlike others, when it depends with how the market goes, there's the element of market risk, if it's shares, the capital gains. But also shares, also it's kind of safer because of the dividend. If you get a share, a company that offers dividends, so it's safe also in that sense. But then things, sophisticated products, CFDs and ETFs, it depends with how the market is. So, but all in all, your asset needs to be as liquid. Like in the case of land, I gave an example. Even right now, it's quite difficult to sell land right now because of the floods. Also, another thing, it needs to be diversified. Yeah, because with diversification, you spread out risk. So in your portfolio, you need to have assets that won't hold 100% of the risk. If it can if you want to, but then it's not advisable. Let it have a percentage of these bonds, a percentage of shares, a percentage of ETF, just to spread it out. Another thing, number 3, your investment should also always protect your capital, because now this capital, you raise it through your savings, through your salary. So what you're investing, it shouldn't eat into the capital. That capital should be grown. And then number 4, your returns should be higher than average return. Yeah, because again, let's go back to land, and let's say you want to build a property or a house that you want to rent it out. So you see the cost, you have to put into account the cost that you incurred buying the land, also building the land. So when you're getting your rental yield, it needs to take into account those costs to break even, and also the inflation rate. Right now we're at 5%. So your investment right now as is should give you a return of above 5%, because the inflation rate is at 5%. So you see, these are the main key issues that you need to consider, when visiting an investment bank. And you see, without the idea of an investment bank, most Kenyans or most Africans are operating on. So as we keep on with this podcast, I will share more into details on the makings and the dealings of an investment bank, which investment banks to visit in Kenya. So thanks for the time. Thanks for having me. Hear me on the next. Goodbye.
The shared perspectives in this podcast are not necessarily the views held by this Generation Africa Podgram or Exhale Sunday. We encourage you to do your due diligence and act sagely on the action prompts provided.